you leaving thousands of dollars on the table? Stay with me. I'll show you how understanding passive activity loss and real estate professional status could unlock major tax savings. Real estate investors, are you missing out on tax savings that could put thousands of dollars back in your pocket? Stick around and I'll show you how passive activity loss and real estate professional status can be your secret weapon to boost cash flow and slash taxes. Before we dive in, let me introduce myself. I am Jhonny Remy, a CPA and certified tax coach with over 20 years of experience helping individuals and businesses navigate the world of taxes. At Nemrac CPA, we focus on simplifying tax strategies so you can grow your wealth confidently. Here is why this matters to you. Passive activity loss is one of the biggest hurdles for real estate investors, but with the right strategy, it can work in your favor. Plus, qualifying as a real estate professional can unlock tax benefits you never knew existed. Let's break it down. So, what is passive activity loss? In simple terms, it's when your rental property deductions, things like depreciation and operating costs, exceed your rental income. Normally, the IRS limits your ability to use these losses to offset other types of income, but there is a way around it. Passive activity loss rules limit the ability to offset net losses from passive activities like rental loss against income from non-passive sources such as salary, wages, self-employment income, interest, dividend, capital gain, pension and social security, annuities, and royalties. This is where the real estate professional status and material participation come in. If you qualify, you can use your rental losses to offset other income, like salary or business earnings. To qualify, you need to meet 3 key criteria. 1. Spend at least 750 hours annually on real estate activities. 2. Dedicate more than half of your work hours to real estate. 3. Materially participate in the day-to-day management of your properties. These 3 qualifications open the door to substantial tax savings. To qualify as a real estate professional, you need to meet 2 criteria. First, you must spend at least 750 hours a year in real estate. Second, more than half of your total work hours must be dedicated to real estate. Once you are eligible for real estate professional status, the third criterion comes into play. You need to actively participate in managing your properties. Material participation means being involved in a business regularly, continuously, and substantially. If you meet any one of these 7 tests, you qualify. Participate 500 hours annually, perform substantially all the participation, or work over 100 hours as much as or more than others. Another way is to have materially participated for at least 5 of the last 10 years or 3 years in personal service activity. Lastly, even if you don't meet the hour threshold, facts and circumstances can demonstrate regular and substantial involvement. Documentation here is key, so track your hours and activities carefully. If you are finding this helpful, hit that subscribe button and click the notification bell so you never miss an update. Follow us on social media for more tips to save money and grow your wealth. The benefits are huge. By qualifying, you can use your rental property losses to offset other income. lowering your taxable income, and boosting your cash flow. This means more money to reinvest or enjoy. Passive activity may be deducted only against and to the extent of a taxpayer's passive activity income. Passive activity losses may be deducted only against and to the extent of a taxpayer's passive activity income. The remainder is carried forward to be used against future passive activity income or upon disposal of the entire property or activity. Here is an example. John, a high school teacher, has the following income and loss at the end of the year. Salary $70,000, rental loss with no participation $25,000, income from a limited partnership investment $10,000. The question is, how much can John offset from those losses, from this $25,000 loss against active income, and how much will he carry forward? John can offset only $10,000 out of his $25,000 loss against and to the extent of the $10,000 income from the limited partnership investment. He will carry the $15,000 balance from this loss over. He cannot offset the remaining $15,000 against his salary because the loss is from a passive activity, the rental in this case, and the salary is considered active. So he will pay tax on his $70,000 salary. However, the tax law provides the following exception. If taxpayer is a real estate professional who materially participates in a real estate professional trade or business, they are not subject to the passive activity loss limitation rules and may use, therefore, rental income losses to offset other sources of non-passive ordinary income. Here is another example. Mary and John, a young couple, file jointly and have multiple sources of income as shown below. The question is whether John is qualified for the real estate professional status. As per the table below, we can see that Mary, let's start with Mary, because let's keep in mind, if John cannot qualify, we can try to figure out whether Mary qualifies, because as per the law, and since they qualify, they file their tax jointly, if any of them qualifies, the couple qualifies. But when we are figuring out whether they meet the real estate professional status requirements, we have to use the hours of only one spouse. Let's start with Mary. Mary, as per the table below, works only 500 hours. This is way below the 750 hours that is required to be a real estate professional. So Mary doesn't qualify. Let's go with John now. John works, as per the table below, a total of, as per the table we are seeing here, a total of 1,350 hours. And out of these 1,350 hours, he works 950 hours in real estate activities, 550 hours in this property, 100 here, and 400 in the brokerage. So this gives a total of 950 hours. But do all these hours qualify to be used in the test for the real estate professional status? No. Even if the time was spent in real estate activities, it has to be an activity in which the taxpayer materially participates. As we know and we will see later on, the 100 hours here that John spent does not qualify because John does not materially participate in the management of this property, and we will see that later. So, as per the table we are seeing here, only the 550 hours and the 300 hours qualify as hours that John can count toward proving that he is a real estate professional. So, John in the year worked 850 hours that qualified toward the real estate professional status test out of 1,350 hours. This is first, more than 750 hours, and second, over 50% of the total of hours that John worked for the year. So John qualifies as a real estate professional. Since John has this real estate professional status, the couple, Mary, has it too. So the couple has the real estate professional status because you just need one of them to qualify for the couple to qualify. Now, the next step is to identify which property they materially participate in the management of which property they materially participate. And we're gonna go through this table here, and we're gonna figure out what property they materially participate in. The first property, John spends 550 hours in its management. So yes, John materially participates because he meets the 500-hour threshold. The second property, Mary spends 200 hours working in it, but nobody else works in it, and nobody works more than Mary, so Mary materially participates in it. The third property is the same. She doesn't have more than 500 hours in it, but nobody works more than her, so she also materially participates in the management of this property. The fourth property, though, is managed by a third party, so neither John nor Mary actively participate in its management, so this property doesn't qualify for the material participation. The third one, the brokerage firm is not a real estate property, so it doesn't really matter for us. Now, which property qualify for the passive activity loss deduction? We just remember, we said that for a property, for a taxpayer to be able to deduct the loss from a real estate property, first the taxpayer has to qualify as a real estate professional, which is true in the case of this couple because John qualifies as a real estate professional. He has the real estate professional status. And now let's see which properties loss we can deduct. We can deduct the loss from this first property because John qualifies as a real estate professional and he materially participates in the management of this property, so this property qualifies for the deduction. The second property qualifies also because since John has the real estate professional status, Mary has it too, and Mary materially participates in the management of this property qualifies. And it's the same for the third property too. John has the real estate professional status and consequently Mary has it too. On top of that, Mary materially participates in the management of this property, so the loss from this property also qualifies for the deduction. Now, what about the fourth property? Yes, John qualifies as a real estate professional, but nobody, neither John nor Mary, materially participates in the management of this property, so this property doesn't qualify for the passive activity loss deduction. However, if the couple decides to elect an aggregation with the IRS, they can include this property and make all the four property become one. In this case, the IRS is not consider those properties to be four properties, but it's gonna consider them to be one and will treat them as one. In this case, they can include the loss from the fourth property, even if they don't materially participate in it. They can include it in the total loss from rental properties and use it to offset income from active sources. Qualifying can be tricky. Common mistakes include not documenting hours properly or misunderstanding the rules. But with expert guidance, you can avoid these pitfalls and maximize your savings. Let's go over some practical tips to maximize your tax savings while meeting the real estate professional requirements. Start by keeping meticulous, accurate, contemporaneous records of hours and tasks. Logs made after the fact won't suffice with the IRS. If you actively participate in multiple rental activities, consider an aggregate election to simplify meeting the 500 rules. However, be cautious about aggregation when passive losses from non-real estate activities could offset rental income. For distant real estate rentals, proving material participation is harder. If you have short-term rentals with average stay of $700 or less, losses may qualify as business losses. So you may not need to qualify for the real estate professional status to deduct those losses as long as you materially participate in the management of those properties. Joint filers can combine spousal hours and always include an election statement when aggregating activities. Lastly, Remember to list yourself as a real estate professional on your tax return and be aware of limitation with limited partnership interest. Ready to unlock these tax benefits? Let us help you maximize savings. At Nemrac CPA, we specialize in guiding real estate investors through complex tax strategies. You can like, share, and subscribe for more valuable insights, and follow us on Facebook, Instagram, and LinkedIn for tips to simplify your financial journey. If you found this information helpful, don't forget to hit that subscribe button and click the notification bell so you never miss an update. Make sure to like, comment, and share this video to help others benefit from these tips. And don't forget to follow us on Facebook, Instagram, and LinkedIn for more financial insights and updates. Join the Nemrac community and let us grow your wealth together.